Hi there, and welcome to Lecture 6 of Banking Risk 2. In this lecture, we're going to go through liquidity risk management and the regulatory requirements for liquidity risk. This lecture will be broken into two parts. First of all, we will go through the various management types, and then we will cover in the second part the liquidity requirements. But in the management type section, we're going to look at the two approaches, but then we're going to look at 5 different metrics or measurements or more disclosure elements that the managers need to look at and observe and report back on their day-to-day activities. Then within the regulatory requirements section, we're going to look at the disclosures. There's 17 different principles of liquidity risk management, and then we'll cover the 2 regulatory requirements included in Basel III. So that is the liquidity coverage ratio and net stable funding ratio. But first of all, let's think about liquidity risk management. We had to ask ourselves, post-financial crisis, do the banks actually manage liquidity risk? What is liquidity risk? Do we need to manage it on a day-to-day basis, or is it something we can do more holistically over time? But the real truth is, given that a bank deals with cash on a day-to-day basis, then liquidity and access to funds needs to be an operational issue day to day. But then at the balance sheet level, there needs to be a level of liquidity stored on the balance sheet. So liquidity can either be kind of day-to-day operational or high-level balance sheet management. The majority of this lecture will focus more on the balance sheet level of liquidity risk management. But the BIS do stipulate the various rules regarding day-to-day liquidity requirements, and even at the bank branch level, they'll have their own levels of liquidity in the event of mass customer withdrawals. And of course, day-to-day liquidity can be modelled and predicted using historic trends. So for instance, in a bank it is very common to know that near the likes of Christmas, there's large withdrawals of cash, as everybody obviously gifts during the festive period. And also that's replicated at the likes of Chinese New Year. So some of these things obviously can be modelled and prepared for well in advance at the operational level. But like I said, the majority of this lecture will focus on the balance sheet sort of funding structure from a liquidity risk point of view. I would like to draw your attention to a paper that's worth reading by De Jong and Yang in 2016, and it was actually called "Do Banks Manage Liquidity Risk?" ? So it will be attached on Blackboard, or you can easily find it through the library repository. And what they did is they observed US banks from 1992 up to 2008 to assess how the likes of banks actually manage liquidity risk. And their findings were that they really thought the banks focus more on the loan to deposit ratio than anything else. And that makes sense, because ultimately you need to know how much stored deposit you have relative to how many loans you give out. So it is a good liquidity ratio from liabilities to assets. And then they also found, certainly post-2012, when the systemically important financial institutions list was introduced, they found that the SIFIs do actually set lower balance sheet targets for liquidity than their smaller counterparts. And again, that makes a little bit of sense, because if you're a large financial institution, then you're likely to access cash and cheaper cash at appropriate timings compared to smaller banks, because you have a certain level of size, counterparties, access to the markets. You're more likely to be able to get access to short-term cash if needs be compared to smaller banks. So they do suggest that the smaller banks hold more liquidity than the larger banks for this reason. So what are the 2 types of liquidity risk management? Well, there is the more traditional bank business model, and then there is the more contemporary complex business model. So the first one being the traditional business model, and this is what the smaller banks and more traditional banks have. So this is your more stored liquidity. And what we mean by stored is the fact they rely quite a lot on customer deposits and less on the short-term funding, the likes of the money market. But when we say stored liquidity management on the asset side, this is really, as you know, customer deposits on the liability side of the balance sheet. But what they do when they have customer deposits on the liability side, some of that will be on the asset side in cash. In other words, it's stored, it's cash sitting in the vault. So your more smaller financial institution, certainly other institutions like credit unions and building societies, will have certainly more of a stored liquidity risk management approach, where they have a lot more customer deposits on the liability side than borrowings for funding purposes. They'll have a lot more cash on the asset side, unlike of someone that has the more contemporary business model for liquidity. Ultimately, this stored process seems to be classed as safer, because if there is a run on the bank, then you have a lot of stored liquidity sitting on your balance sheet to kind of be the buffer for any sort of bank run. However, it's also quite expensive. Not expensive as in monetary terms, but expensive as in opportunity cost, because if you have cash sitting in your asset doing nothing, then it's doing nothing, and if it is cash, it might be getting chewed away by the likes of inflation. So it's seen as safer, but there's quite a lot of opportunity cost involved in that. And the second approach is the more purchase liquidity management, and that's more focused on the liability side. And this is your more contemporary, complex business model, where to fund your assets, you have obviously customer deposits being the core, but you do rely more on the financial markets for short-term borrowing to help fund your assets. Obviously, if you're a large financial institution, you have good access to the money markets, then of course you will be able to potentially get cheap borrowings on a revolving basis, and in times of stress, then potentially you'll still have access given your size and your creditworthiness or lower counterparty risk. However, it is obviously a more risky business model, because if you have to fund your assets based on short-term borrowing, and we see the likes of the financial crisis again, where the money markets really dried up and the banks were unwilling to lend to each other, then the cost of this borrowing potentially outweighed the benefits of receiving from the assets. So in the case of a yield curve flipping, your borrowing costs on the short term spike relative to the income on your long-term assets drop, so your net interest income could become negative. So this is something you obviously need to manage effectively if you've got the more liquidity purchase business model. So let's have a look at an example. So this first example is demonstrating the more stored liquidity management technique. And what you can see in the top panel, panel A, is a balance sheet before any sort of run on the bank. So you can see you have 70 as deposits on the liability, but of that 70, 9 of it is just on the asset side in cash. And you can see on the liability side that they don't really borrow too much from the financial markets to fund their assets. So they have 70 customer deposits, and of that, 9 is in form of liquid cash on the asset side. In the panel below, panel B, we have simulated a drop of 5 in the deposits. So if you have a stored liquidity on the asset side, then that effectively is 5 of your cash going. So what we've simulated on the asset side is the drop in the cash. But you can see the other assets remain the same. The other on the liabilities stay exactly the same. But obviously what we can see is the balance sheet was 100, now it's overall shrunk to 95. So this 5 run on the bank was really a hit on our cash in our asset side. But the overall balance sheet shrunk to 95 from 100. So let's look at how we might potentially counteract this. So again at the top, in panel A, we have the before and after. So in this time, instead of having the stored, we've just put assets as 100 rather than breaking down between cash and what have you. So this is the event where we don't have the cash stored. So similar example, you can see we had 70 deposits, but in this case we've had a run on the bank. Again, 5 is gone from our deposits, so our deposits are now 65. If we don't have the cash on the asset sides to take the impact and take the hit, and then we need to maintain our balance sheet at 100 on both sides, therefore we have to increase our 10 borrowing up to 15 borrowing to offset the run on our liabilities we have to borrow an extra 5. Now let's think about this extra 5 borrowing. If it's a large financial institution, then it's probably okay. We'll probably be able to get that. But think about what is the cost of capital? How much is it going to cost to borrow this additional 5? But think about if this is in times of stress and the likes of short-term interest rates are really high, then it could be potentially expensive. So when we have to borrow more money, we have to think cost of capital, times of stress being depressed prices or even higher interest rates. Obviously that links back to cost of capital. But then that adds in additional counterparty risk because we're borrowing from someone else. So obviously this purchase liquidity sort of route can get expensive depending on the likes of market conditions. Okay, now let's look at a different perspective of what we've just done. So we're going to look now at the effect of this extra 5 in loan commitment. So if we look at panel A, the top half, A is before the exercise and simulates there is no actual bank run, but we have just committed to an extra 5 million in borrowing. Then panel A, B, the top right, shows us this extra commitment on the asset side in other assets as increasing from 91 to 96. And that's because we have borrowed, and that is additional cash that can be used on the asset side. But obviously, if you look in the top right hand corner, the balance sheet doesn't match. We have 105 now on the asset side, and we have 100 on the liability side. Therefore, that needs to be simulated. So if we go to panel B, the bottom half now, so BA shows us this extra 5 borrowing on the liability side, which is essentially 5 on the other assets. So our balance sheet is, of course, now 105. So the extra additional borrowing on the liability side has to be reflected on the asset side. So that's why the balance sheet is now got the extra 5 on both asset and liability. But if you look at panel B, the more stored liquidity rather than the contemporary, that just shows you that if we have the more stored approach, then ultimately we don't need to simulate the additional borrowing on the liability side and the cash just drops by 5. For more detailed discussion of this example, feel free to read the appropriate pages in the Sanders and Cornett core textbook. So if we want to compare the two approaches in a summary, then of course we have the traditional asset approach or the more contemporary liability management approach. Then the traditional route focuses on the asset to liability ratio, more specifically the loan to customer deposit ratio, as highlighted in that research in 2016, is what banks really focus on. And when liquidity risk arises, then they could potentially face a hit if their cash reserves run out, and that may force them to sell some of their securities, depreciating their balance sheet further. And as noted before, the potential opportunity cost there for storing cash is quite high. Thus, if you're storing more cash, you might not be as profitable. And from a stability point of view, quite a lot of the key metrics for financial stability base on how profitable the bank is. So storing a lot of cash is good from a safety point of view for liquidity, but arguably if you're not as profitable, you might not be seen as safe, even though you are. So it is a bit of a counterintuitive depending on which indicator you look at it from a safety point of view overall. But then the more liquidity management contemporary approach, obviously the more complex, needs a lot more operational management, certainly from the Treasury Department, of what your borrowing is relative to your reserves. Obviously this approach is easier in normal times and a positive yield curve, and if you have access to funds quite cheaply and quite often, but in times of stress, this is where you may face problems. If the interest rates on borrowing goes up and market liquidity dries up, or the bank's actual own credit risk or counterparty risk increases, then your access to short-term funds for liability becomes an issue. And if there's speculation that you can't borrow from the money markets or you can't go to the lender of last resort, then ultimately you might face a run on the deposit you have as well. And that's what we see in the case of the likes of Northern Rock. But if you have this sort of model and you're reliant on the lender of last resort, then that could have moral hazard issues in general. the fact that you can be reckless, have this more contemporary business model, which could be quite aggressive for profit, but if you go to the lender of last resort quite often and they bail you out, then that sends a signal of moral hazard throughout the sector and gives people incentives to have this model if they're just going to get bailed out if times are stressed. So there's for and against for both liquidity management techniques. As well as the management techniques, there is various liquidity theories. Now, some of them are relevant to liquidity risk management or potentially just liquidity risk in general. So do have a look at these various liquidities. I mean, we covered liquidity preference theory when we covered interest rates, but obviously still applies for liquidity risk management because being locked in for longer, whether that's an asset or liability side of the balance sheet, then you're going to want to be compensated more for doing so. But do have a look at the likes of liquidity preference theory again, the shiftability theory, the anticipated income theory, and just the general liquidity management theory, which suggests that banks really don't need to store liquidity because they can access it through the money market, which obviously could become a problem in times of stress if you have that more contemporary business model. Okay, now we're going to move on to look at some of the kind of metrics that the banks may use when managing liquidity. Now, you could argue that these are some type of measurement technique, but really it's kind of a monitoring process, and certainly the Treasury Department within a bank will monitor these, and we'll obviously measure these, but they're more metrics to observe and react to rather than overall liquidity risk measurement techniques that we covered last week. So these are done by the Treasury Departments, and they're just kind of good key metrics, and they will be disclosed, of course. So you have the loan to deposit ratio, 1 week and 1 month liquidity ratios, a cumulative liquidity model, intercompany reporting, and an overall liquidity factor. And you see from the Treasury core textbook about liquidity risk, this is the suggestions they make of the effectiveness and what these measurements could be used for. So some are obviously for kind of day-to-day liquidity activities, some are potential warning signals for future stress. So the loan to deposit ratio is one of the most simplest forms of monitoring liquidity within a bank, and that's what the likes of the De Jong and Yang paper suggested, that most banks focus on this. And in research, quite a lot of authors use the loan to deposit ratio as a key metric to measure liquidity risk. So it's certainly something for you guys to look at if you're looking at a bank's balance sheet from a liquidity point of view. And of course, there's more than one type of loan to deposit ratio. It depends on what type of deposit they include, but more importantly, what type of liabilities and what type of specific loans that they put into this ratio. Because you could have a more short-term one where it looks at short-term deposits to short-term loans, or could look at overall deposits relative to long-term loans. So be careful when you look at the loan-to-deposit ratio to see how it's actually calculated and what's included on both sides of the ratio, because that could impact the level of liquidity severely, depending on the calculation. It potentially could be misleading. But also note what currencies it's in, because deposits in different countries obviously attract a different interest rate and inflation factor, and that goes the same for loans as well. But it is a very common sort of technique that's used, and it'll be one of the key metrics on the bank's balance sheets. Also, the likes of banks will do weekly and monthly reporting regarding the levels of liquidity in various currencies, and they'll potentially have operational targets on how much liquidity they want in various different currencies and countries, and they will report on a segmental basis per country. Typically, this data is stored within the bank and isn't really publicly available, so you wouldn't really get access to this granular data from any of the disclosures they produce, but the Treasury Department would obviously monitor this on a regular basis and then potentially forecast the amount of liquidity they need to store over the next week or over the next month, depending on market conditions and general activity of when liquidity is required. Like Christmas, more cash is required for gifting. And this will also kind of tie into the foreign exchange risk management of the institution when working out if they need to change any sort of net cash flows in different currencies. Next is the cumulative liquidity model. Now you're probably thinking, hold on, I've seen this before. But actually the model we did in the last lecture was based on maturity and size. So we had the various assets and liabilities broken down into the various buckets. However, this one is more of a cash flow analysis. So it kind of forecasts the incoming and outgoing at the various time buckets and works out, is there a potential funding gap on what's coming in versus to what's going out from a liquidity point of view. So kind of similar to, we've seen the repricing model, but obviously the repricing model only looked at rate sensitive assets and liabilities. This cumulative liquidity model actually looks at all incomings and outgoing, whether that's variable or fixed. Again, as an outsider, we're not going to get access to this sort of metrics and this information for this granular level. But of course, the Treasury Department of the bank will get access to this, and of course will monitor it. And if there is large cumulative gaps in certain time buckets, then they might potentially alter their balance sheet, or they may potentially get additional borrowing to kind of fund the assets if there's quite a lot of outgoings rather than incomings later on, or depending on when this occurs in the maturity bucket. They also do the likes of intercompany lending reports, and this is really kind of about cash flow management between branches, and the fact that if there's a need for liquidity in Asia, the likes of Chinese New Year, then they might transfer cash from the likes of the UK European branches to the Asian branches to ensure that any sort of withdrawals in Asia can be met. And obviously that might be reversed at the times of Christmas, where the more European and American market might do more withdrawals at Christmas, then they may shift money from the likes of their Asian branches. So this is really monitoring cash flow around the world and again in different currencies. But ultimately we need to think about the kind of IT infrastructure and recording aspect of this kind of lending reports. Given how dynamic this sort of transactions are, it's about the case of, if you have a large institution, is all this data captured? Is it captured timely? And how often is it reported? So potentially more of an operational challenge of getting the data, certainly if you need a forecast 1 month in advance for these sort of reports. But as an outsider, we would not get access to this information. Then we have the liquidity factor ratio, which actually links quite nicely to lecture 3 when we covered the duration, because it looks at the asset duration in years and then divides the duration by the liability tenure. Now obviously the liability tenure is not duration of the liabilities, it's more about when the cash flows are due. But essentially, if this was to show that it had a high liquidity factor, then that essentially means there's more liquidity risk in the fact that your assets are very long, but your payments due, your tenures due on the liabilities is quite short. Therefore, you might face liquidity problems if all your payments and your assets are not to be received a long time in the future. Then you might not have access to liquidity to pay the short-term tenures of the liabilities. But this sort of thing is more long-term, so you need to kind of look at the more average asset duration relative to the average tenure over time to kind of look at the availability of payments of the liabilities across time. But ultimately, we don't get access to this information, but the treasurers in the banks will obviously want to try and keep this level stable or reduce it if it's rather high. And then lastly, we do have the more management information system of reporting liquidity. And you can imagine within the Treasury Department of a bank, they will have various weekly reports on day-to-day activities, whether that's cash flow movement in and out the bank, whether that's cash flow movement between branches and subsidiaries, also various different currencies. Then they're probably going to report this on a weekly basis for monitoring. And then they might look at the likes of the loan to deposit ratio and liquidity ratios more over a month to see kind of this stable impact of liquidity. Now within the management, you'll have seen the key metrics that they may use to monitor liquidity positions. Then what they also kind of need to look at is the various different disclosures or reporting that they may provide externals like us. So the previous ones we can't really get access to except from the loan to deposit ratio, which is provided annually or quarterly on the balance sheet. But the other things investors may see through the likes of the Pillar 3 disclosure report is any sort of maturity mismatch. Of course, this also links to interest rate risk. They may show the mismatch in foreign exchange or what is stored in various currencies. They give you an idea of the scale of liquidity in the assets and liabilities, which is also known as the ladder, because some of the assets are very illiquid compared to cash liabilities, which are very liquid. And they will also demonstrate the amount of kind of funding concentration, so produce a report showing you where the majority of their funding is from. And ideally, if you've got more stored liquidity management technique, you're going to have more customer deposits as your key source of funding, with that being stored as cash on the asset side of the balance sheet. So first of all, the maturity mismatch model. This does look like something we've seen before when we talked about the repricing model for cash flows. Of course, that didn't include the fixed income. So this sort of maturity mismatch will include both rate sensitive and non-rate sensitive assets and liabilities, and potentially project the incomings and outgoings over various time buckets just to highlight the kind of liquidity position or the cash flow movement. And of course, this will feed into the likes of the net interest income calculation. But ultimately, you need to look at what you have coming in versus what you have going out, certainly to make sure that you have enough stored liquidity to potentially fund in the short time if there's more outgoings than there is incoming. But this is typically done again by the Treasury at various different time buckets. And if you remember from interest rate risk, BIS suggested over 19 different buckets should be assessed. They will also look at the likes of the mismatch in funding per currencies. Obviously, this feeds into the foreign exchange rate risk management. And if you remember back to banking risk 1, sometimes it's easier to do borrowing in a foreign currency to fund assets in that foreign currency rather than transferring from the likes of the UK to America and face the foreign exchange rate risk. So you will potentially have a look at your assets and your liabilities from a foreign exchange rate point of view to see how much liabilities do you have in certain FX relative to your assets. And if you can see this example here, you can see that there's potentially a mismatch and there's a large amount of US dollars on the funding side relative to the lending asset side, but there's certainly a deficit in the euro and the pound. Now, obviously, from a funding point of view, if you have a very strong US dollar, then that's sitting on your balance sheet and that's good. However, if the likes of the US dollar was to depreciate, then ultimately your balance sheet would shrink in that aspect. So this sort of mismatch needs to be managed appropriately. Now, obviously, you might not get to a full point of immunization where you have zero mismatch between different currencies, because operationally that might not be possible. But if you have fears of a currency depreciating, then it might be more appropriate to make sure the mismatch is lower. Regarding the asset and liability ladder, Treasury Department will look at their balance sheet as a whole view and think, okay, we have a lot of customer deposits, which will be split into two. So you'll have the kind of short-term customer deposits, which is more the cash flow that keeps going in and out of the bank. But then we also potentially go, well, actually, customer deposits can be quite sticky, certainly long-term savings. So we'll think, well, how much of the deposits are short-term, how much are potentially more sticky long-term, then compare that to the asset side. So cash reserves, obviously very liquid, cash in the vault, but ultimately the loans to retail customers on the mortgages or commercial loans are potentially much longer, and the likes of property they own is obviously very liquid in the fact that it takes a long time to sell a property to get it back into cash. So they may kind of look at a holistic view of the balance sheet and go, okay, what is liquid and what is not, and what is the potential mismatch along this ladder. And then lastly, from this reporting point of view, they will look at the funding concentration Again, this funding concentration will be broken down over various time buckets, and you might want to look at the likes of, are we over-reliant on certain funding tools? And if you have the likes of a high concentration on the interbank money market, then you think at times of stress, this could become an issue when we need to get access to additional funding to service our assets. So you might want to look at where do you actually concentrate your funds from. Now, if it is on the money market and lending from other institutions, you will also look at the kind of concentration exposure to various counterparts. Because if you over-rely on borrowing from a certain bank, if that bank struggles, then you're going to struggle to get cash from them. And then can you get cash from somewhere else if you have high counterparty risk with another financial institution? So you can't basically put all your funding in one basket. You need to have a good diversified funding basket. And this kind of looking at funding concentration will help you assess over various time horizons what your exposures are. Again, from a regulatory point of view, the regulators want you to be more diversified on your funding structure and not rely on certain aspects. But I suppose from a stored liquidity point of view, having a heavy reliance on customer deposits, it is kind of seen as more stable as long as you don't face a run on your bank. And this concludes part 1 of the lecture.
Hi there, and welcome to the second part of Week 6 lecture on liquidity risk regulation and management. In this part, we're going to go through the regulatory requirements for liquidity risk management. Firstly, we're going to talk about the Bank of International Settlement Principles of Sound Liquidity Management. Now, these principles were actually set out during the financial crisis of 2008, and actually, these principles are still relevant to today. Even in January 2019, the BIS conducted a review of the principles and announced that they're still relevant and they don't need to be adjusted. Obviously, these principles have stood the test of time, but also on top of these principles, as we'll cover later on, the Basel Committee introduced the liquidity coverage ratio and the net stable funding ratio in Basel III. But these principles remain relevant today. So, these principles. Well, firstly, there is 17 of them, with the first 13 being relevant for the banks and the final 4 being relevant to the supervisors and their role in sound liquidity risk management. Before we got to here in 2008, the likes of Basel I, 1.5, 2, 2.5, and this was actually wrote before Basel III, which was introduced in 2010, this was the first point of regulatory requirements regarding liquidity risk, as the previous Basels really focused on credit risk and market risk. So these being introduced was kind of the first step for liquidity risk management, which beforehand, from a regulatory point of view, was rather neglected. I'll briefly outline the principles here, but of course, take your time to read the document and read the slides to get a better understanding of the various 13 principles that are relevant to the banks. So the first one, nice and simple, the bank is responsible for sound management of liquidity risk. Rather vague, I get that, but it's obviously the first step. Principle number 2, in acknowledging principle 1, the senior management must set out a certain risk tolerance when it comes to liquidity risk. Principle number 3, again, bestows that the senior management must have some sort of strategy in place regarding liquidity management to ensure that it maintains sufficient liquidity. Principle 4 is that the bank should take into account any sort of costs when it comes to purchasing liquidity and ensure that any sort of borrowed funds, whether on balance sheet or off balance sheet, is priced accordingly, and that they do take into account at times of stress that pricing or costs of borrowing could go up. Principle number 5 outlines that there should be essentially a comprehensive framework in place when it comes to liquidity risk, and that is in the case of identification, measuring, monitoring, and controlling the risk. Principle number 6 is that there must be some sort of framework in place to monitor the various liquidity exposures across the likes of different business lines, foreign exchange, and various different legal entities of the bank. Principle 7 is all about the funding strategy, and that there must be some sort of policy in place to ensure there is a reduction in reliability on one concentration of funding. In other words, make sure your funding on the liability side is rather diverse and that you don't rely on one source for the likes of borrowing on your liability side of the balance sheet. Principle 8 outlines the more intraday position of liquidity to ensure that banks actively manage their day-to-day operational liquidity requirements. Principle 9 is regarding specific products that require collateral. So this principle requires banks to actively manage any sort of collateral positions that they have in case the likes of a margin call is needed to ensure they have enough liquidity to match any sort of collateral if it's required to be paid. And as part of this liquidity, they need to make sure that in the whatever contract of the product is, the legal entity and the physical location of the collateral is known and it can be provided in a timely manner in the event of it being paid. Principle number 10 is all about stress testing on a regular basis, following various stress test scenarios that BIS provide. Principle 11 is all about emergency funding plans, so potentially having something operationalized in the event of emergency. So you have a liquidity shock. Where are you going to potentially source additional funding? What is your policy on using repurchase agreements, for instance? This sort of contingency plan must also be stress tested in a range of various scenarios, specifically in depressed and stressed markets. Principle 11 is all about maintaining some sort of unencumbered highly liquid assets. So these assets are not backed against something, therefore these assets will remain in the event of times of stress and no one can have a legal claim on these assets to make sure that there is this sort of liquidity on the asset side of the balance sheet. Now, this principle is really built into the liquidity coverage ratio. Thus, if you're maintaining your liquidity coverage ratio requirement, then you would be hitting Principle 12. And finally, from the bank's point of view, Principle 13, banks must have a certain level of liquidity risk management disclosures in their annual report and, of course, their Pillar 3 disclosure report, which is also required by the regulators. Then Principle 14 to 17 is all about the role of the supervisor when it comes to liquidity risk management. Take some time to have a look at this table, and this was research conducted by an undergraduate student a year after these principles were introduced. In this research, the author looked at 6 UK banks and their annual report of 2018 when these principles were introduced. And what you can see clearly is, first of all, on the right, the likes of Northern Rock, who ultimately faced liquidity crises and had to be bailed out by the UK government and subsequently sold. You can see they had numerous issues when it came to meeting these principles of sound liquidity risk management. But also, look at Principle 9, where banks should actively manage their collateral positions. The author argued that banks didn't really do this sort of activity, and if collateral was required, then they could potentially acquire collateral from the likes of the money markets. And also, Principle 4, the author argued that liquidity wasn't really taken into account on all products. It was only potentially looked at in some cases, mainly on the most highly illiquid products. But also the author argued that off-balance sheet items were not really discussed that much from a liquidity point of view on or in the annual reports. Now if we look towards the bottom, Principle 12, which is now technically the liquidity coverage ratio, the majority of the banks, except from HSBC, really didn't meet this requirement to maintain a certain level of unencumbered high-quality assets, and ultimately making this author's job more tricky. Principle 13 about disclosure, well really there wasn't much liquidity disclosure at all prior to these principles being introduced and the likes of the Basel III, Pillar 3 disclosure requirement. So this table kind of highlights that during the financial crisis, there was a lot of non-adherence to liquidity risk in general prior to these principles being introduced. And this also gives cause to the fact that it's a good idea for these principles to be introduced to shine a light on when institutions weren't actually managing liquidity appropriately. This table was conducted by another undergraduate student in 2016, looking at the likes of Standard Chartered Bank in detail and discussing whether or not they complied with these principles in 2015, so a full 7 years after these principles were introduced. And you can see the author here went through the annual report of Standard Chartered Bank to see whether they potentially provided information on the various principles and made a subjective argument whether the bank complied or not using a traffic light system, with some justification in the text here. Now, let's look at the new liquidity requirements that were introduced in Basel III. And these were first proposed in 2010. And first of all, we'll start with the liquidity coverage ratio, which was consulted on until 2013 to come into effect from January 2015. And as you can see from the formula, it is high quality liquid assets over net cash outflows over a 30-day period, and this ratio must be equal to or above 100%. Regarding the rollout of the liquidity coverage ratio, it wasn't an immediate rollout, so the fact that from January 2015 you had to hit 100%. It started being phased, so the likes of 2015 only had to be 60%, year later 70, 80, 90, and then 100% or above from 2019 onwards. So of course, today in 2021, all banks must adhere to this by plus 100%. And if we look at the net stable funding ratio, this was consulted on until October 2014, due to come into force from January 2018. Again, with a similar rollout strategy, with the 100% requirement being needed by 2022. And this formula is the amount of stable funding divided by the required amount of stable funding. And we'll go into this in more detail shortly. But if you look at these two ratios, you can see one is more short-term, liquidity coverage ratio, and one is more long-term, more stable funding. So you could argue that the liquidity coverage ratio is more market, net stable funding ratio is more funding. So more market focused, the other one more funding focused. But definitely short term, i.e. over 30 days, compared to the funding, which is a year plus. When these were first proposed in 2010, the academic response from research was on the whole positive, but with caveats regarding criticality. So the likes of King and Talbot argue that these are one of the most important aspects of the whole Basel III announcement. And Bundle, Wig and Atkins arguing that this inclusion in Basel III will reduce the bank's reliance and dependence on the central bank and reduce the likes of moral hazard in the financial system. But the critics argued that with the likes of liquidity coverage ratio, it's very difficult to collect the data, certainly when it comes to the net cash outflows over a 30-day period. And from the net stable funding ratio, the argument was that more stable funding will become more expensive to potentially get access to or to hold on your balance sheet, causing a lot of opportunity cost of just holding cash and not making it profitable. So if we look at the first sort of consultation regarding both the ratios and what they must include, you have liquidity coverage ratio on the left, net stable funding on the right. You can see what the top half of the formula requires compared to what the bottom half of the formula requires. But ultimately, each part of the formula requires a lot of data and potentially lots of runoff or haircut factors to various assets and liabilities. And you can imagine, as an outsider looking in or researcher, it's quite difficult to get access to a lot of this information. Thus, the use of proxies is needed from an external point of view. Of course, from a treasury point of view within the bank, they'll have access to this information in order to make the calculations, and then of course they must disclose it securely, because some of this might be commercially sensitive, to the regulators. But even with detailed documents produced by the BIS, banks to this day were still struggling on how to actually calculate these formulas, even to the extent that recently the Bank of England produced a spreadsheet which the likes of financial institutions can use to potentially calculate their own exposures and help guide them to understand the formulas for both LCR and net stable funding. So let's have a look at how the liquidity coverage ratio implementation has gone for the banks. These charts are taken from the monitoring reports that are done on a biannually basis by the Bank of International Settlement, and you can see the links in the notes section of the slide to get access to the document. And whenever they produce these monitoring reports, they break it down into 3 groups. Group 1, which is your large banks. Then they break it down further. Of the large banks in Group 1, they look at the specific globally systemically important banks. And then they have Group 2, which are your smaller banks and the likes of building societies. But of course, do have a look at the monitoring report to get a full understanding of what's classified in Group 1 or Group 2 banks. But ultimately here, if you look at October 2019 report compared to the December 2020 report, there does seem to be a much greater improvement in Group 2 than the likes of Group 1 and the globally systemically important banks. If you're unfamiliar of what this chart presents, then do go and have a read up on how to interpret a box and whisker plot. But if we take this example here in December 2020, the box is your interquartile range between 25% and 75% percentile, with the horizontal line being your mean and the lines being your kind of tails. But on the whole here for Bank 2, you can see in the October 2019 report there was at least some banks or one bank in the sample that didn't actually meet the liquidity coverage ratio. But this suggests that all banks in Group 2 did meet the liquidity coverage ratio, and some of them certainly exceeded well above 300% coverage. If we look at the globally systemically important banks, you can see there has been a certain level of improvement. Certainly some bank in this list has a much higher liquidity coverage ratio than required at above 200%. But again, all banks actually are above 100. But in the group of 1, so the large banks, you can see there might be one or another or some in this group that still just fall short of the liquidity coverage ratio. Now, it is obviously a case of what do you do if a bank falls short of its liquidity coverage ratio, because obviously this is a regulatory requirement. Well, whenever a bank fails to meet its regulatory requirements, then they do get extra supervision in place to make sure that they correct this issue. If it is persistent, then the regulator can step in and levy the appropriate fines or mandate the bank to do so. In these charts, we have a breakdown of the liquid assets. On the top half, we have October 2019. On the bottom half, we have December 2020. On the left-hand side, we have the weighted amount compared to the right-hand side, which is the actual nominal amount. And it's all in percentage terms. As part of the liquidity coverage ratio requirement, you must have certain securities at what's classed as level 1 and level 2. For more information on what is level 1 and what is level 2 regarding assets, do have a look at the finite detail of liquidity coverage ratio within the Basel III document. But what you can see here on the whole is that the smaller banks, the banks in Group 2, typically rely quite a lot of level 1 securities compared to the big banks, which typically have more level 2A assets. And it could be argued that the larger banks probably have more easier access to purchase in level 2 assets, given they've got a better credit rating or counterparty risk compared to the smaller banks in Group 2. But it's interesting on the whole, you can see that whether you're a smaller bank or a larger bank, that ultimately you have somewhere between 30 to 40% of assets dedicated to cash or central bank reserves. And that shows you the amount of actual cash the banks hold for liquidity purposes. Up to 40% of your assets is in cash or reserves with your central bank. And think about the opportunity cost of just having that. Now let's look at the net stable funding ratio. This diagram tries to show you the various haircuts that you need to apply to certain assets and liabilities to be included in the formula of amount of stable funding divided by required amount of stable funding. But to break down that further, you can see the formula along the bottom, which is actually a proxy from research, where academic authors use this formula as a more detailed proxy to the actual net stable funding ratio where we can't get access to data, with all the information in this long formula being publicly available in the annual report of the financial institution. Now obviously this formula is only a proxy, but this was mainly used before the disclosure requirement of the net stable funding ratio was actually mandatory. So if you are to look in the annual reports now, as of 2021, you should see the banks producing the net stable funding ratio in its Pillar 3 disclosure report. But in order to potentially evaluate historically what the bank's net stable funding ratio may have been before they had to disclose this, then the likes of this formula was used in research articles. This slide just acknowledges that during the consultation process, what actually changed regarding the haircuts from when it was announced in 2010 before the end of the consultation in 2014. There wasn't really much change on the haircuts except from on the asset side, the loans and advances to banks, which was excluded, was given a 50% haircut when actually included. But on the liability side, there was a slight change in the haircuts regarding customer deposits, whether they are term, demand or savings. Here we have a proxy calculation for Barclays in 2018, and at the time of the report they didn't actually disclose the net stable funding ratio. Therefore, using the formula we've seen earlier on and the various data available on the balance sheet, we were able to potentially calculate a proxy that in 2018 Barclays did actually meet the net stable funding ratio, having 130%, which is obviously above the required 100% requirement. And again, this is some sort of task that you may be able to do and backdate if your bank doesn't produce the net stable funding ratio within its Pillar 3 disclosure report. Again, if we look at how the implementation of the net stable funding ratio is going, we can look at the monitoring report. Again, we will compare the likes of October 2019 to December 2020. And as you can see on this one, compared to the liquidity coverage ratio, the tails for both Group 1 and Group 2 do fall short of the 100% requirement. So there is some institutions that don't meet the net stable funding ratio requirement as of December 2020. But on the whole, you can see that from the interquartile range of both groups is above 100, hovering around the 110 to 140 mark on average, with all the globally systemically important banks meeting the 100% requirement in December 2020. But clearly, there is a lot of work to be done in the Group 2 smaller banks, as the max and min are very spread out and the interquartile range is much larger. But it'll be interesting to see over the next couple of years, as this is required, to see how banks adapt to make sure that they are meeting the 100% requirement, but potentially not superseding it well above the likes of 180, because that could be very costly to do. And for the banks that don't actually meet the net stable funding ratio requirement, King 2018 produced this diagram on suggesting how a bank may potentially increase its net stable funding ratio, and that's looking at the formula and saying, how do you increase available stable funding, the top half of the formula, or how you could decrease the required stable funding, the bottom half of the formula. And the author breaks it down into various different types, looking at what's actually built in to the top half and the bottom half of the formula. So do take time to have a look at this diagram and understand how a bank could potentially operationally increase its net stable funding ratio by the various different components within the formula. Also, when the principles of sound liquidity risk management were introduced in 2008, the BIS also suggested various ways and options for financial institutions to improve their liquidity funding structure. Of course, this diagram was produced well in advance of liquidity coverage ratio and net stable funding ratio, but ultimately it's still quite applicable to how a bank may increase its liquidity position. So do have a look at the various components in the diagram, but some of them will have obviously been superseded by the liquidity coverage ratio and net stable funding ratio. Following the introduction of both of the ratios you can see from a research point of view the various advantages and disadvantages. Now, all these papers are included on your Blackboard site within the liquidity theme academic journals folder. These papers were selected mainly because they were wrote at the time of implementation to see what the immediate response from academic literature would be and academia's thought on these requirements before or as they're starting to be rolled out within the real world. So you might potentially look at these potential advantages and disadvantages and then now conduct your own research in 2021 onwards to see what authors now believe regarding both of these ratios. And myself, in my PhD, I did actually use that ratio proxy for the net stable funding ratio within one of my research papers for the PhD. And I actually found that the likes of increased net stable funding ratio actually hampered profitability and then in turn hampered financial stability of the institution. So the purpose of net stable funding ratio is to have more stable funding over a long time horizon to make the bank safer. Well, actually, I found it might be counterintuitive because the likes of the cost of available funding and stable funding increased due to the introduction of this regulation. So the costs of funding actually grew. The opportunity cost of holding additional cash meant that banks were not as profitable. And because most financial stability measures focus on the likes of profitability in the calculation, then this ratio hampered profitability, which could ultimately hamper investor confidence and the stability of the bank in general. So from a liquidity point of view, quite liquid, but from a profitability and stability point of view, potentially harmful. And this is the sort of research you may start reading when you look into the adoption of LCR and net stable funding ratio. And you might want to compare and contrast what the new research says compared to the initial thoughts regarding the advantages and disadvantages. But on the whole, at the time, most academics and regulators argued that the introduction of liquidity requirements is a good thing for the sector as a whole and definitely needed post-financial crisis. If we now have a look at how the likes of the implementation is going at country level regarding the liquidity requirements, the BIS do produce a biannually report on the adoption of the Basel Accords for its various jurisdictions and summarises it because, as you know, the BIS don't have the legal capacity to implement these regulations. They set out the principles and the guidance, i.e. write Basel III, but it's up to the individual jurisdictions to put it into law. So each country must look at the accords and then implement them through their legislative process. Obviously, some countries have a more slicker process of implementing laws than others. For instance, originally, the likes of Saudi Arabia were able to put the Basel III Accords into law very quickly, unlike the European Union, who has a much longer process when implementing various laws. And if you can see the adoption since the report in October 2018 up until the most recent at the time of recording, July 2020, you can see there's been more progress on the monitoring of intraday liquidity management, or also known as liquidity coverage ratio. Compare that to the implementation of the net stable funding ratio. Obviously, the LCR was required from January 15 compared to net stable funding ratio January 2018. But even so, you have some jurisdictions that haven't even published draft regulation regarding LCR, namely China, Japan, Korea, and Mexico. And then in subsequent reports, we can see the likes of not applicable for Mexico, and this is because their central bank already gathers and computes various intraday liquidity management tools, and they've obviously at a country level negotiated with the Basel Committee regarding that they have other sufficient policies and procedures in place to manage short-term day-to-day activity for liquidity, and therefore got an exemption for actually implementing the full Basel Accord in this aspect. But regarding the net stable funding ratio, you can certainly see some progress, and notably through the three adoption reports I've got on the screen here, Canada, have certainly made a lot of progress from going from 1 to 3 to finally 4 in the most recent report of actually having the rules in force. But there is obviously still room for improvement for a number of countries who are still at the draft regulation stage. And noticeably, this also includes the United States. Still, in July 2020, they're only at the draft regulation stage for the net stable funding adoption. Do have a look at the links in the notes section of this slide to get a better understanding and more depth about individual countries on how they're adopting these regulations. But despite the fact that some countries don't have these requirements fully in law yet, you can see since 2012 up to, again, the most recent information of 2019, the shortfall, which is the bar charts, are actually very low for both liquidity coverage ratio and net stable funding ratio. And on the whole, the averages, the line charts, have been going up. So if you look back to 2012, the bar chart, the blue one, for net stable funding ratio, suggesting an extreme shortfall in the fact that shortfall meaning the banks haven't met the 100% requirement. You can see, if we look at the Group 1 banks on the left, the nominal amount of shortfall was well over 1,250 billion euros. So near the scale of work that would be required for the banks to make that shortfall zero. And obviously, back in 2012, net stable funding ratio hadn't been fully formalised, or the standard hadn't even been set and hadn't needed to be implemented. But you can see from then the amount of progress banks have had to get that shortfall all the way down to pretty much zero in 2019. And certainly there has been a good steady decline in the shortfall from 2013 up till the likes of 2016 as the phasing implementation of the two ratios was introduced. But again, do have a look at the full detail and the interpretation of this chart from the document from the link in the note section of this slide. So there I've covered the two liquidity requirements that the Basel III Accords stipulate. And in the previous lecture, I covered the various liquidity risk measurement techniques that banks may do on their balance sheet. But here are a few alternative measures of liquidity risk that authors, academics, have produced with their appropriate reference. And again, the papers are included on your Blackboard site to have a better reading understanding of these potential measurement techniques for liquidity risk are. But the top one is using COVAR, but changing that to assess asset and liability liquidity risk. Acumen et al. In 2009 suggested a risk assessment model for systemic institutions. In other words, a certain model for the institutions that are more connected with one another. Pelotti and Souza suggested having the likes of Piggovian tax on short-term funding. Piggovian tax, I think, is a more American term for a sort of moral hazard sort of taxation. These suggested that you should potentially raise tax or have a certain cost added to when you use short-term funding, and then this sort of tax is stored in the case of market stress so that central banks or regulators can use this tax fund to potentially provide additional liquidity support to the bank. But quite a lot of papers argue that this is a narrow view and that obviously funding isn't solely based on short-term money markets, and this task on simply one source of funding may ultimately drive people away from doing short-term borrowing in the first place and potentially going for more riskier ways of funding or much more safer ways of funding in the case of just using customer deposits. But it does oversimplify the concept, suggesting that just taxing one source of funding might solve the problem. Lee 2013 argued for a measurement that looked at the shortfall between interbank lending. Hugh, Pan and Wang 2013 collected data on market liquidity and looked at the statistical noise information from illiquid markets. And Jobstus 2014 looked at a systemic risk-adjusted liquidity model, which was seen as one of the first liquidity models to try and measure financial stability across various banking institutions. But to get a better understanding of what these authors propose, do have a read of the full papers. But overall, when we've talked about liquidity risk in Theme 2, you could argue that it is a three-legged stool. In other words, if you take away one leg, it'll still fall over, with one of the legs being to maintain a sufficient structural liquidity cushion, with the ability to manage what's going in and what's going out at any point in time across the various time buckets. 2, ensuring that you have some sort of contingency liquidity in place, therefore you don't have to rely heavily on certain funding concentrations or potential expensive funding in times of stress. And 3, ensuring that you have the means to turn your assets into liquid reserves if required, but also making sure that this can be done in a timely fashion, certainly in times of stress. And without all three, cash flow, funding contingency, and liquefying your own balance sheet, without all three, you wouldn't be as stable. As part of your directed study for this theme, certainly have a read of the various chapters in your core textbooks regarding liquidity risk measurement and management. Do additional reading regarding the net stable funding ratio and liquidity coverage ratio. Specifically look at banks' annual reports to see what their disclosure is, how do they meet these requirements, and potentially assess the bank's risk attitude towards liquidity risk and meeting these regulatory requirements. And do review the research papers that I've referenced to throughout this presentation to get a better understanding of the liquidity coverage ratio and net stable funding ratio. Thank you for watching this lecture.